So what's changed? So I talked about it before. I won't go into it too much here, but you have to now, instead of being able to deduct your R&D spend from revenue, you now have to capitalize that over a 5-year period for domestic R&D and over a 15-year period for foreign R&D. And I'll show you the impact of what that actually looks like on the next slide. The other part is that net operating losses. Before you could deduct that entire amount of R&D spend and often claim a loss. And then you could use those net operating losses or NOLs to then offset taxable income later on. So say, for example, I owed $100,000, but I've had $1 million of net operating losses that I've accumulated over my existence as a company. I could just use those NOLs to offset. And they used to offset 1-to-1, so 100%. Now those NOLs are less valuable because they only offset 80% of taxable income. So 2 major changes. So what does capitalization even mean? Let's see, what's the real world impact? So got this example company. Think about this company maybe they do research, they do software development, or maybe pretty early stage. They might develop, they've cut out. Can you hear me?
Yeah, it's coming back in. You're all right.
Great. Cool. So this company, they do technical work, software development, robotics development, hardware, whatever it might be. And so they have $1 million in revenue, and this $2 million in spend is for salaries for supplies that go into prototyping. So what that company could do in the past was take this $2 million expenses, subtract it from revenue, and then claim $1 million in losses. So you didn't owe any taxes. So how the world works now with R&D capitalization in place is that same company, $2 million in spend, can deduct just a fraction of what they could in the past. So now, in the first year of this change, you can deduct just $200,000 from revenue, and now you have an $800,000 taxable income. And if you apply a 21% tax rate, you now have a $168,000 tax bill that you weren't expecting because you're operating at a considerable loss. So this is surprising a lot of companies that are in a similar position as this, but also companies that are already profitable. They were expecting a tax bill similar to something last year, maybe a little bit higher if their profits improved, but now the tax bill might be 4x larger.
And this is just general for the tax law. This has nothing to do so far with R&D tax credit. This is just the change in the tax law in the first place, and suddenly there's a lot of tax bills that are a lot higher.
Exactly.
Essentially, the government raised taxes while they claimed to cut it to 21%. In fact, they raised it in some cases.
Exactly. Yes.
And this is also problematic for companies too, because early stage companies, you don't know what you're going to look like in 5 years. Like 5 years is a really long period of time for an early stage startup.
Exactly. There are, if you go on LinkedIn and search Section 174, there is a ton of noise with small business startups that are like small business technology companies that are like, they're raising the alarm about this because a lot of people until very recently didn't even know this was in effect. So we're educating customers, we're helping them deal with this change and also stay compliant while also helping claim the credit to lighten the load, the impact of what the tax change can be for the business.
Yeah. So essentially this means, just to kind of restate the point, right? Which is, hey, the company lost $1 million they spent $1 million essentially venture capital funds, most likely, right? They had to cash somehow, spend $1 million of that. Now they have to spend an extra $168,000 on top of the money they spent, which is going straight to the government, not for work building their business or anything else. It's going straight to the government on top of their already $1 million that they essentially lost or overspent of their VC dollars. There's $168,000 on top they also need to allocate for taxes because of revenue.
Exactly, and it's completely unexpected.
Yeah, so you didn't plan for it, and now there goes that extra engineer you were going to hire, or other business development work you were planning to grow your business and make a better startup.
100%. That is, Adam, you hit the nail on the head.
Cool. Yep.
Section 41, the expenses that Nicole talked about, wages, contractor expenses, supplies, cloud computing, those things fall under the section and they get you the credit. And then there's a broader section, which is section 174, which, as you see, encompasses section 41. This used to be able to, this is a category that could just be deducted. But now you have to think about each of those expenses where you didn't really have to before. And I have to go through the fine-tooth comb and identify which ones get credit and which ones have to be capitalized. And why I bring this up is because NeoTax, when you go through the process of claiming the credit, it gets you most of the way there to being compliant with this new tax change. And our software can help you do that, which we'll show you shortly.
And just to check as well, Ben, I mean, like, what is the from what my understanding, there's a lot of companies, not to like do a major compare and contrast with you guys and like other vendors that are out there, but a lot of them don't take this into account. And so they just were doing things the old way. And that actually then suddenly created greater tax liability than companies expected. And it actually, if they didn't do this the right way, it almost didn't make sense to do the R&D tax credit at all. So like walk me through like why you guys noticed this, maybe other companies didn't, or how that worked out for people. And trying to think through whether you do a tax credit, R&D tax credit.
Yeah, our leadership team, Ibrahim and Frost, Ibrahim's our CEO and Frost our CTO. They said this change was passed 5 years ago, and there was a 5-year clock for when it would go into effect. And they thought that no one was talking about it. There was too much going on with all that's going on in the world that it wasn't going to get repealed. So they started to build a software solution to address this challenge, and nobody else did. Accountants didn't take it into effect. Everyone just thought that dragged their feet on this. So NeoTax is the only software provider that will help you get the credit and stay compliant with Section 174. If you just claim the credit and you don't take Section 174 into account, you're not complying with IRS regulations and guidelines, but it also could potentially open up for an audit. So it's something that you really have to be careful about. And most of our folks in our space, they don't really, they say that, oh, it's going to get repealed. It's going to be repealed. Don't worry about it. We'll just get the credit. And we want to advise on the IRS guidelines that are in place today, not what we think may happen down the road.
You.